Hi friends, very good evening. In today's video, I'll be talking about how investors may invest in financial markets. Before that, disclaimer, please note that this is a free educational video purely for the purpose of learning. This should in no manner be considered as any kind of an advice, offer, or promotion to sell anything. Information here is purely for the purpose of viewer/investor education only. While making this video, I have put things in perspective basis on my understanding. There are no guarantees of the accuracy of content or figures stated. Viewers or investors must do their own due diligence. I will not be responsible for any kind of financial loss on account of the content stated in this video. Viewers, investors are expected to consult their own financial experts while reaching any financial decisions. No reference has been drawn to any country or financial markets while making this video. Financial market means, in my understanding for this particular video, what I mean to say is all possible investment instruments, their markets like equity markets, debt markets, bond markets, gold markets, real estate, or any other thing which I could think of possibly to be included in my understanding of financial markets. Okay, so keeping that in mind, I have made this video. Wherever I have used the word can, I basically mean may. And the pointers which I'll be sharing would not be in hierarchy of importance. Rather, all pointers that I would be sharing would be equally important. Okay, now coming to the topic. So the first point which I want to make is how investors may invest in financial markets. So firstly, most important thing is the goal of the investor, the investment horizon. So the investment horizon and the goal is very important. The goals could be short term, medium term, long term, like marriage of kids is a medium term goal. Short term goal could be vacation, long term goal could be marriage. So the investment horizon would change depending upon these type of goals. Each goal would have different investment horizon and accordingly the plan. Okay, coming to the risk profile, the investor needs to have a proper risk profile. That means, is he a moderate risk, heavy risk customer, or he is a conservative type of customer? Depending upon that, he should choose his investment decision and avenues. For first-time investors, it may be a decent idea to look at investing into debt or equity hybrids, especially through the mutual fund routes. So this could be one form of getting into these things. Of course, all this the investor needs to do keeping in mind the tax laws for that particular region to which he belongs and at a particular time. Of course, laws also could change with time. Then asset allocation would play an important role. What I mean by that, not keeping all eggs in one basket. Investor needs to look at investing some into equity, debt, gold, real estate, bonds, whatever be the things depending upon the risk profile. Then most importantly, it could be stop timing the market, which is one big mistake which investors do. Aim for long-term investment horizon, which is important. Of course, there are no guaranteed returns in market, but a minimum 7 to 10 years horizon is kind of what investors may look at, because of course there are no guaranteed returns, but the probability of getting a return increases with time. Of course, that also is not guaranteed, but of course this could be one pointer to look at. Okay, now coming to the other point which I also wanted to make, I had written down, is that lump sum and piecemeal investment option both could be used as strategy. That means it could depend upon the kind of asset at hand which the investor is looking at. And keep the investment strategy simple. Much, and I hope you like this video. Take care.